Do you dream of a life where your money works for you, effortlessly multiplying into substantial wealth? Look no further, for we have the secret to your financial ascension. Imagine living a life of abundant possibilities where financial worries become a thing of the past. This is not just a fantasy, but an achievable reality with our meticulously crafted investment plan. So if you're ready to break the rules of common sense and enter the exciting world of high returns, join us on this journey. Number 7, high-yield savings accounts. A high-yield online savings account is a great choice if you want to earn interest on your cash amount. It works like a regular savings account at a brick-and-mortar bank, but you can make more interest on it. It's especially helpful for people who might need cash shortly. If you prefer to avoid taking risks with your money, a high-yield savings account is a safe choice because the banks that offer them are often FDIC insured. This means that your deposits are safe up to the limits of government insurance. Even though these accounts are safe, if the interest rates are too low, there's a small chance that your money will lose value over time because of inflation. Online banks, on the other hand, have much higher interest rates than standard brick-and-mortar banks because they have lower overhead costs. Number 6, short-term certificates of deposit. Certificates of deposit, or CDs, are a type of investment that banks offer. Usually, the interest rates on CDs are higher than on regular savings accounts. They are good for retirees who don't need money immediately and can afford to keep their money locked up for a while. CDs are a safe option for buyers who don't want to take risks but want more return than they get from a savings account. But there is a chance of reinvestment. That means that the returns could be lower when the principal and interest are put into new CDs with lower rates. On the other hand, if you think rates will go up, consider short-term CDs so you can return your money at higher rates. It's important to consider inflation and taxes because they can affect how much your cash can buy. Number 5, Series 1 bonds. The U.S. Treasury offers savings bonds for individual investors, and one popular option is the Series 1 bond, designed to protect against inflation. It consists of a base interest rate and an additional component tied to the inflation rate, resulting in increased payouts when inflation rises. However, if inflation falls, the interest rate decreases accordingly. The inflation adjustment is reset every 6 months. Series 1 bonds are ideal for risk-averse investors who prioritize safety and want to safeguard their investments against inflation. There is a limit of $10,000 in purchases per calendar year, but you can also apply up to an additional $5,000 from your annual tax refund towards the purchase. Plus, there's a lesser-known method to bypass this annual limit. The bonds offer protection against inflation, making them a secure investment option, and they earn interest for 30 years if not redeemed for cash, fluctuating based on prevailing inflation rates. Number 4, short-term corporate bond funds. Corporations often raise funds by issuing bonds to investors, which can then be bundled into bond funds that own bonds from various companies. Short-term bonds with an average maturity of 1 to 5 years are less susceptible to interest rate fluctuations than intermediate or long-term bonds. Corporate bond funds, including short-term ones, are suitable for investors seeking cash flow, like retirees or those aiming to reduce overall portfolio risk while still earning returns. Risk-averse investors looking for slightly higher yields than government bond funds may also find short-term corporate bond funds appealing. However, it's important to note that bond funds, including short-term corporate bond funds, are not FDIC insured. There's a risk of credit rating downgrades or companies facing financial difficulties and defaulting on the bonds. To mitigate this risk, choosing funds composed of high-quality corporate bonds is advisable. Investment-grade short-term bond funds often offer higher returns than government and municipal bond funds, but the potential for greater rewards comes with increased risk. Number 3, dividend stock funds. Dividend stock funds are investment options that package together dividend-paying stocks, providing regular cash payouts to shareholders. These funds are particularly appealing for investors seeking income and a relatively safer option within the stock market. By diversifying holdings through dividend stock funds, investors can reduce risk compared to investing in individual stocks. It's important to carefully select dividend stocks based on their history of dividend increases rather than solely relying on high current yields. While dividend stocks still come with risks, such as the potential for companies to reduce or eliminate dividends, investing in a diversified dividend stock fund can help mitigate these risks. The rewards of dividend stock funds include the potential for long-term market appreciation and regular cash earnings. These funds are available as ETFs or mutual funds through brokers, with ETFs often offering advantages like no minimum purchase requirements and commission-free trading trading. Number 2, value stock funds. Value stock funds are ways to invest in less expensive stocks than others on the market. When stocks are overpriced and investors are looking for chances, these funds can be a good choice. It's important to remember that value stock funds are best for buyers comfortable with the volatility of stock investments and have at least 3 to 5 years to ride out market changes. Even though value stock funds are better than other types of stock funds because they are cheaper, they still have risks and are not insured by the government. When interest rates go up, value stocks tend to do better, while growth stocks may become less attractive. This shows that value stock funds pay off. Also, many value stock funds pay dividends, which makes them even more appealing. There are 2 types of value stock funds: exchange-traded funds, ETFs, and mutual funds. ETFs are often commission-free and have no minimum purchase requirement at big online brokers. Number 1, REIT index funds. REIT index funds offer investors an attractive way to invest in real estate without the hassle of property management. These funds consist of publicly traded REITs, companies that own and operate income-generating real estate properties. By investing in REIT index funds, investors can gain diversified exposure to various real estate subsectors such as lodging, apartments, and offices, all within a single fund. One of the main advantages of REITs is their ability to pass on substantial dividends to investors, making them particularly appealing to income-focused investors like retirees. Additionally, REITs have the potential for capital appreciation over time. However, it's important to note that the prices of publicly traded REITs can be volatile, requiring investors to adopt a long-term perspective and be prepared for market fluctuations. While owning an REIT index fund provides diversification, investors should still be cautious of non-publicly traded REITs or funds. The rewards of investing in REIT index funds come from growing dividends and potential capital appreciation, with historical annual returns averaging around 10 to 12%. To invest in REIT funds, you can purchase them through brokers that allow the trading of ETFs or mutual funds. Remember to assess the risk levels associated with each investment option and consider your financial goals, time horizon, and risk tolerance. Diversification across different asset classes and diligent research are key to building a well-rounded portfolio that offers the potential for high returns while managing potential downsides. So that's all for today's video. If you liked this video, click the like and the bell buttons. We'll have another video for you soon. Take care until then.